11. Security analysis for the lay investor. General approach. Financial analysis is now well-established and flourishing. Profession or semi-profession, the various societies of analysts that make up the National Federation of Financial Analysts have over 13,000 members, most of whom make their living out of this branch of mental activity. Financial analysts have textbooks, a code of ethics, and a quarterly journal. They also have their share of unresolved problems. In recent years, there has been a tendency to replace the general concept of security analysis by that of financial analysis. The latter phrase has a broader implication and is better suited to describe the work of most senior analysts on Wall Street. It would be useful to think of security analysis as limiting itself pretty much to the examination and evaluation of stocks and bonds, whereas financial analysis would comprise that work, plus the determination of investment policy, portfolio selection, plus a substantial amount of general economic analysis. In this chapter, we shall use whatever designation is most applicable, with chief emphasis on the work of the security analyst proper. The security analyst deals with the past, the present, and the future of any given security issue. He describes the business. He summarizes its operating results and financial position. He sets forth its strong and weak points, its possibilities and risks. He mates its future earning power under various assumptions, or as NBAG, best guess, knees or rough, the same company at various times. Finally, he expresses an opinion as to the safety of the issue, if it is a bond or investment grade preferred stock, or as to its attractiveness as a purchase, if it is a common stock. In doing all these things, the security analyst avails himself of a number of techniques ranging from the elementary to the most abstruse. He may modify substantially the figures in the company's annual statements, even though they bear the sacred imprimatur of the certified public accountant. He is on the lookout, particularly for items in these reports that may mean a good deal more or less than they say. The security analyst develops and applies standards of safety by which we can conclude whether a given bond or preferred stock may be termed sound enough to justify purchase for investment. These standards relate primarily to past average earnings, but they are concerned also with capital structure, working capital asset, values, and other matters. In dealing with common stocks, the security analyst until recently has only rarely applied standards of value as well defined as were his standards of safety for bonds and preferred stocks. Most of the time, he contented himself with a summary of past performances, a more or less general forecast of the future, with particular emphasis on the next 12 months, and a rather arbitrary conclusion. The latter was, and still is, often drawn with one eye on the stock ticker or the market charts. In the past few years, however, much attention has been given by practicing analysts to the problem of valuing growth stocks. Many of these have sold at such high prices in relation to past and current earnings that those recommending them have felt a special obligation to justify their purchase by fairly definite projections of expected earnings running fairly far into the future. Certain mathematical techniques of a rather sophisticated sort have perforce been invoked to support the valuations arrived at. We shall deal with these techniques in foreshortened form a little later. However, we must point out a troublesome paradox here, which is that the mathematical valuations have become most prevalent precisely in those areas where one might consider them least reliable. For the more dependent the valuation becomes on www.lo.org. Anticipations of the future, and the less it is tied to a figure demonstrated by past performance, the more vulnerable it becomes to possible miscalculation and serious error. A large part of the value found for a high multiplier growth stock is derived from future projections which differ markedly from past performance, except perhaps in the growth rate itself. Thus, it may be said that security analysts today find themselves compelled to become most mathematical and scientific in the very situations which lend themselves least auspiciously to exact treatment. Let us proceed nonetheless with our discussion of the more important elements and techniques of security analysis. The present highly condensed treatment is directed to the needs of the non-professional investor. At the minimum, he should understand what the security analyst is talking about and driving at. Beyond that, he should be equipped, if possible, to distinguish between superficial and sound analysis. Security analysis for the lay investor is thought of as beginning with the interpretation of a company's annual financial report. This is a subject which we have covered for laymen in a separate book entitled The Interpretation of Financial Statements. We do not consider it necessary or appropriate to traverse the same ground in this chapter, especially since the emphasis in the present book is on principles and attitudes rather than on information and description. Let us pass on to two basic questions underlying the selection of investments. What are the primary tests of safety of a corporate bond or preferred stock? What are the chief factors entering into the valuation of a common stock? Bond analysis. The most dependable and hence the most respectable branch of security analysis concerns itself with the safety or quality of bond issues and investment-grade preferred stocks. The chief criterion used for corporate bonds is the number of times that total interest charges have been covered by available earnings for some years in the past. In the case of preferred stocks, it is the number of times that bond interest and preferred dividends combined have been covered. The exact standards applied will vary with different authorities. Since the tests are at bottom arbitrary, there is no way to determine precisely the most suitable criteria. In the 1961 revision of our textbook, Security Analysis, we recommend certain coverage standards which appear in Table 11-1. Our basic test is applied only to the average results for a period of years. Other authorities require also that a minimum coverage be shown for every year considered. We approve a poorest year test, B for investment-grade preferred stocks. The same minimum figures as above are required to be shown by the ratio of earnings before income taxes to the sum of fixed charges plus twice preferred dividends. Note, the inclusion of twice the preferred dividends allows for the fact that preferred dividends are not income tax deductible, whereas interest charges are so deductible. See other categories of bonds and preferreds. The standards given above are not applicable to 1. Public utility holding companies, 2. Financial companies, 3. Real estate companies. Requirements for these special groups are omitted here. It may, as an alternative to the 7-year average test, it would be SUFI, scient if the bond or preferred stock met either of these criteria. Be objected that the large increase in bond interest rates since 1961 would justify some offsetting reduction in the coverage of charges required. Obviously, it would be much harder for an industrial company to show a 7 times coverage of interest charges at 8% than at 4%. To meet this changed situation, Weno suggests an alternative requirement related to the percenternen, the principal amount of the debt. These figures might be 33% before. Taxes for an industrial company, 20% for a public utility, and 25% for a railroad. It should be borne in mind here that the rate actually paid by most companies on their total debt is considerably less than the current 8% figures, since they have the benefit of older issues bearing lower coupons. The poorest year requirement could be set at about 2/3 of the 7-year requirement. In addition to the earnings coverage test, a number of others are generally applied. These include the following. 1. Size of enterprise. There is a minimum standard in terms of volume of business for a corporation, varying as between industrials, utilities, and railroads, and of population for a municipality. 2. Stock equity ratio. This is the ratio of the market price of the junior stock issues to the total face amount of the debt, or the debt, plus preferred stock. It is a rough measure of the protection, or cush, ion afforded by the presence of a junior investment that must first bear the brunt of unfavorable developments. This factor includes the market's appraisal of the future prospects of the enterprise. 3. Property value. The asset values, as shown on the balance sheet or as appraised, were formerly considered the chief security and protection for a bond issue. Experience has shown that in most cases safety resides in the earning power, and if this is deficient, the assets lose most of their reputed value. Asset values, however, retain importance as a separate test of ample security for bonds and preferred stocks in 3 enterprise groups, public utilities, because rates may depend largely on the property investment, real estate concerns, and investment companies. At this point, the alert investor should ask, how dependable are tests of safety that are measured by past and present performance in view of the fact that payment of interest and principal depends upon what the future will bring forth? The answer can be founded only on experience. Investment history shows that. Bonds end. Preferred stocks that have met stringent tests of safety based on the past have, in the great majority of cases, been able to face the vicissitudes of the future successfully. This has been strikingly demonstrated in the major field of railroad bonds, a field that has been marked by a calamitous frequency of bankruptcies and serious losses. In nearly every case, the roads that got into trouble, headlong, been overbonded, had shown an inadequate coverage of fixed charges in periods of average prosperity, and would thus have been ruled out by investors who applied strict tests of safety. Conversely, practically every road that has met such tests has escaped financial embarrassment. Our premise was strikingly vindicated by the financial history of the numerous railroads reorganized in the 1940s and in 1950. All of these, with one exception, started their careers off with fixed charges reduced to a point where the current coverage fixed interest requirements was ample, or at least respectable. The exception was the New Haven Railroad, which in its reorganization year 1947 earned its new charges only about 1.1 times. In consequence, while all the other roads were able to come through rather difficult times with solvency unimpaired, the New Haven relapsed into trusteeship for the third time in 1961. In Chapter 17 below, we shall consider some aspects of the bankruptcy of the Penn Central Railroad, which shook the financial community in 1970. An elementary fact in this case was that the coverage of fixed charges did not meet conservative standards as early as 1965. Hence, a prudent bond investor would have avoided or disposed of the bond issues of the system long before its financial collapse. Our observations on the adequacy of the past record to judge future safety apply, and to an even greater degree to the public utilities which constitute a major area for bond investment. Receivership of a soundly capitalized electric utility company, or system, is almost impossible, since Securities and Exchange Commission control was instituted along with the breakup of Mostoff. The holding company system's public utility financing has been sound and bankruptcies unknown. The financial troubles of electric and gas utilities in the 1930s were traceable almost 100% to financial excesses and mismanagement, which left their imprint clearly on the company's capitalization structures. Simple but stringent tests of safety, therefore, would have warned the investor away from the issues that were later to default. Among industrial bond issues, the long-term record has been different. Although the industrial group as a whole has shown a better growth of earning power than either the railroads or the utilities, it has revealed a lesser degree of inherent stability for individual companies and lines of business. Thus, in the past at least, there have been persuasive reasons for confining the purchase of industrial bonds and preferred stocks to companies that not only are of major size, but also have shown an ability in the past to withstand a serious depression. Few defaults of industrial bonds have occurred since 1950, but this fact is attributable in part to the absence of a major depression during this long period. Since 1966, there have been adverse developments in the financial position of many industrial companies. Considerable difficulties have developed as a result of unwise expansion. On the one hand, this has involved large additions to both bank loans and long-term debt. On the other, it has frequently produced operating losses instead of the expected profits. At the beginning of 1971, it was calculated that in the past 7 years, the interest payments of all non-financial firms had grown from $9.8 billion in 1963 to $26.1 billion in 1970, and that interest payments had taken 29% of the aggregate profits before interest and taxes in 1971. Against only 16% in 1,963.3, obviously, the burden on many individual firms had increased much more than this. Overbonded companies have become all too familiar. There is every reason to repeat the caution expressed in our 1965 edition. We are not quite ready to suggest that the investor may count on an indefinite continuance of this favorable situation, and hence relax the standards of bond selection in the industrial or any other group. Common stock analysis, the ideal form of common stock analysis, leads to a valuation of the issue, which can be compared with the current price to determine whether or not the security is an attractive purchase. This valuation, in turn, would ordinarily be found by estimating the average earnings over a period of years in the future and then multiplying that estimate by an appropriate capitalization factor. The now standard procedure for estimating future earning power starts with average past data for physical volume, prices received, and operating margin. Future sales in dollars are then projected on the basis of assumptions as to the amount of change in volume and price level over the previous base. These estimates, in turn, are grounded first on general economic forecasts of gross national product, and then on special calculations applicable to the industry and company in question. An illustration of this method of valuation may be taken from our 1965 edition and brought up to date by adding the sequel. The value line, a leading investment service, makes forecasts of future earnings and dividends by the procedure outlined above, and then derives a figure of price potentiality or projected market value by applying a valuation formula to each issue based largely on certain past relationships. In Table 11-2, we reproduce the projections for 1967 to 1969 made in June 1964 and compare them with the earnings. An average market price actually realized in 1968, which approximates the 1967 to 1969 period. The combined forecasts proved to be somewhat on the low side, but not seriously so. The corresponding predictions made 6 years before had turned out to be over-optimistic on earnings and dividends, but this had been offset by use of a low multiplier, with the result that the price potentiality figure proved to be about the same as the actual average price for 1963. Good deal more. The reader will note that quite a number of the individual forecasts were wide of the mark. This is an instance in support of our general view that composite or group estimates are likely to be dependable than those for individual companies. Ideally, perhaps, the security analyst should pick out the 3 or 4 companies whose future he thinks he knows the best, and concentrate his own and his client's interests on what he forecasts for them. Unfortunately, it appears to be almost impossible to distinguish in advance between those individual forecasts which can be relied upon and those which are subject to a large chance of error. At bottom, this is the reason for the wide diversification practiced by the investment funds. For it is undoubtedly better to concentrate on one stock that you know is going to prove highly profitable, rather than dilute your results to a mediocre figure merely for diversification's sake. But this is not done, because it cannot be done dependably. The prevalence of wide diversification is in itself a pragmatic repudiation of the fetish of selectivity to which Wall Street constantly pays lip service. Factors affecting the capitalization rate. Though average future earnings are supposed to be the chief determinant of value, the security analyst takes into account a number of other factors of a more or less definite nature. Most of these will enter into his capitalization rate, which can vary over a wide range, depending upon the quality of the stock issue. Thus, although 2 companies may have the same figure of expected earnings per share in 1973 to 1975, say $4, the analyst may value one as low as 40% and the other as high as 100%. Let us deal briefly with some of the considerations that enter into these divergent multipliers. 1. General long-term prospects. No one really knows anything about what will happen in the distant future, but analysts and investors have strong views on the subject just the same. These views are reflected in the substantial differentials between the price-earnings ratios of individual companies and of industry groups. At this point, we added in our 1965 edition. For example, at the end of 1963, the chemical companies in the DJIA were selling at considerably higher multipliers than the oil companies, indicating stronger confidence in the prospects of the former than of the latter. Such distinctions made by the market are often soundly based, but when dictated mainly by past performance, they are as likely to be wrong as right. We shall supply here, in Table 11-3, the 1963 year-end material on the chemical and oil company issues in the DJIA, and carry their earnings to the end of 1970. It will be seen that the chemical companies, despite their high multipliers, made practically no gain in earnings in the period after 1963. The oil companies did much better than the chemicals and about in line with the growth implied in their 1963 multipliers. Thus, our chemical stock example proved to be one of the cases in which the market multipliers were proven wrong. Celerny, 2, management, On Wall Street, a great deal is constantly said on this subject, but little that is really helpful. Until objective, quantitative, and reasonably reliable tests of managerial competence are devised and applied, this factor will continue to be looked at. Through a fog, it is fair to assume that an outstandingly successful company has unusually good management. This will have shown itself already in the past record. It will show up again in the estimates for the next 5 years, and once more in the previously discussed factor of long-term prospects. The tendency to count it still another time as a separate bullish consideration can easily lead to expensive overvaluations. The management factor is most useful, we think, in those cases in which a recent change has taken place that has not yet had the time to show its significance in the actual figures. 2 spectacular occurrences of this kind were associated with the Chrysler Motor Corporation. The first took place as far back as 1921, when Walter Chrysler took command of the almost morbid Maxwell Motors, and in a few years made it a large and highly profitable enterprise, while numerous other automobile companies were forced out of business. The second happened as recently as 1962, when Chrysler had fallen far from its once high estate, and the stock was selling at its lowest price in many years. Then new interests associated with consolidation coal took over the reins. The earnings advanced from the 1961 figure of $1.24 per share to the equivalent of $17 in 1963, and the price rose from a low of 38% in 1962 to the equivalent of nearly 200 the very next year. 3. Financial strength and capital structure. Stock of a company with a lot of surplus cash and nothing ahead of the common is clearly a better purchase at the same price than another one with the same per share earnings but large bank loans and senior securities. Such factors are properly and carefully taken into account by security analysts. A modest amount of bonds or preferred stock, however, is not necessarily a disadvantage to the common, nor is top-heavy the moderate use of seasonal bank credit. Incidentally, A structure too little common stock in relation to bonds, and preferred may, under favorable conditions, make for a huge speculative profit in the common. This is the factor known as leverage. 4. Dividend record. One of the most persuasive tests of high quality is an uninterrupted record of dividend payments going back over many years. We think that a record of continuous dividend payments for the last 20 years or more is an important plus factor in the company's quality rating. Indeed, the defensive investor might be justified in limiting his purchases to those meeting this test. 5. Current dividend rate. This, our last additional factor, is the most difficult one to deal with in satisfactory fashion. Fortunately, the majority of companies have come to follow what may be called a standard dividend policy. This has meant the distribution of about 2/3 of their average earnings, except that in the recent period of high profits and inflationary demands for more capital, the figure has tended to be lower. In 1969, it was 59.5% for the stocks in the Dow Jones average and 55% for all American corpo rations, where the dividend bears a normal relationship to the earnings. The valuation may be made on either basis without substantially affecting the result. For example, a typical secondary company with expected average earnings of $3 and an expected dividend of $2 million, say, be valued at either 12 times its earnings times its dividend, to yield a value of 36% in both cases. Or 18. However, an increasing number of growth companies are departing from the once standard policy of paying out 60% or more of earnings in dividends on the grounds that the shareholder's interest will be better served by retaining nearly all the profits to finance expansion. The issue presents problems and requires careful distinctions. We have decided to defer a discussion on the vital question of proper dividend policy to a later section, Chapter 19, where we shall deal with it as a part of the general problem of management-shareholder relations. Capitalization rates for growth stocks. Most of the writing of security analysts on formal appraisals relates to the valuation of growth stocks. Our study of the various methods has led us to suggest a foreshortened and quite simple formula for the valuation of growth stocks, which is intended to produce figures fairly close to those resulting from the more refined mathematical calculations. Our formula is value current normal earnings x 8.5 plus twice the expected annual growth rate. The growth figure should be that expected over the next 7 to 10 years. In Table 11-4, we show how our formula works out for various rates of assumed growth. It is easy to make the converse calculation and to determine what rate of growth is anticipated by the current market price, assuming our formula is valid. In our last edition, we made that calculation for the DJIA and for 6 important stock issues. These figures are reproduced in Table 11-5. We commented at the time 4% annual growth rate for Xerox and the extremely modest 2.8% for General Motors is indeed striking. It is explainable in part by the stock market's feeling that General Motors' 1963 earnings, the largest for any corporation in history, can be maintained with difficulty and exceeded only modestly at best. The price-earnings ratio of Xerox, on the other hand, is quite representative of speculative enthusiasm fastened upon a company of great achievement and perhaps still greater promise. The implicit or expected growth rate of 5.1% for the DJI Comet pairs with an actual annual increase of 3.4% compounded between 1951 to 1953 and 1961 to 1963. We should have added a caution somewhat as follows. The valuations of expected high-growth stocks are necessarily on the low side if we were to assume these growth rates will actually be realized. In fact, according to the arithmetic, if a company could be assumed to grow at a rate of 8% or more indefinitely in the future, its value would be infinite, and no price would be too high to pay for the shares. What the valuer actually does in these cases is to introduce a margin of safety into his calculations, somewhat as an engineer does in his specifications for a structure. On this basis, the purchasers would realize his assigned objective in 1963, a future overall return of 71.2% per annum, even if the growth rate actually realized proved substantially less than that projected in the formula. Of course then, if that rate were actually realized, the investor would be sure to enjoy a handsome additional return. There is really no way of valuing a high-growth company with an expected rate above, say, 8% annually, in which the analyst can make realistic assumptions of both the proper multiplier for the current earnings and the expectable multiplier for the future earnings. As it happened, the actual growth for Xerox and IBM proved very close to the high rates implied from our formula. As just explained, this fine showing inevitably produced a large advance in the price of both issues. The growth of the DJIA itself was also about as projected by the 1,963 closing market price. But the moderate rate of 5% did not involve the mathematical dilemma of Xerox and IBM. It turned out that the 23% price rise to the end of 1970, plus the 28% in aggregate dividend return received, gave not far from the 7% annual overall gain posited in our formula. In the case of the other 4 companies, it may suffice to say that their growth did not equal the expectations implied in the 1,963 price, and that their quotations failed to rise. As much as the DJIA warning, this material is supplied for illustrative purposes only, and because of the inescapable necessity in security analysis to project the future growth rate for most companies studied. Let the reader not be misled into thinking that such projections have any high degree of reliability, or conversely that future prices can be counted on to behave accordingly as the prophecies are realized, surpassed, or disappointed. We should point out that any scientific or at least reasonably dependable stock evaluation based on anticipated future results must take future interest rates into account. A given schedule of expected earnings or dividends would have a smaller present value if we assume a higher than if we assume a lower interest structure. Such assumptions have always been difficult to make with any degree of confidence, and the recent violent swings in long-term interest rates render forecasts of this sort almost presumptuous. Hence, we have retained our old formula above, simply because no new one would appear more plausible. Industry analysis, because the general prospects of the enterprise carry major weight in the establishment of market prices. It is natural for the security analyst to devote a great deal of attention to the economic position of the industry and of the individual company in its industry. Studies of this kind can go into unlimited detail. They are sometimes productive of valuable insights into important factors that will be operative in the future and are insufficiently appreciated. Why the current? Where a conclusion of that kind can be drawn with a fair degree of confidence, it affords a sound basis for investment decisions. Our own observation, however, leads us to minimize somewhat the practical value of most of the industry studies that are made available to investors. The material developed is ordinarily of a kind with which the public is already fairly familiar, and that has already exerted considerable influence on market quotations. Security rarely does. One, find a brokerage house study that points out, with a convincing array of facts, that a popular industry is heading for a fall or that an unpopular one is due to prosper. Wall Street's view of the longer future is notoriously fallible, and this necessarily applies to that important part of its investigations which is directed toward the forecasting of the course of profits in various industries. We must recognize, however, that the rapid and pervasive growth of technology in recent years is not without major effect on the attitude and the labors of the security analyst. More so than in the past, the progress or retrogression of the typical company in the coming decade may depend on its relation to new products and new processes which the analyst may have a chance to study and evaluate in advance. Thus, there is doubtless a promising area for effective work by the analyst based on field trips, interviews with research men, and on intensive technological investigation on his own. There are hazards connected with investment conclusions, derived chiefly from such glimpses into the future and not supported by presently demonstrable value. Yet there are perhaps equal hazards in sticking closely to the limits of value set by sober calculations resting on actual results. The investor cannot have it both ways. He can be imaginative and play for the big profits that are the reward for vision proved sound by the event, but then he must run a substantial risk of major or minor miscalculation. Or he can be conservative and refuse to pay more than a minor premium for possibilities as yet unproved, but in that case he must be prepared for the later contemplation of golden opportunities foregone. A two-part appraisal process. Let us return for a moment to the idea of valuation or appraisal of a common stock, which we began to discuss above on P288. A great deal of reflection on the subject has led us to conclude that this better be done quite differently than is now the established practice. We suggest that analysts work out first what we call the past performance value, which is based solely on the past record. This would indicate what the stock would be worth absolutely, or as a percentage of the DJIA or of the S&P IT, if it is assumed that its relative past performance will continue. Compos, unchanged in the future. This includes the assumption that rate of growth rate as shown in the last 7 years will also carried out mechanically by applying a formula that gives individ continue unchanged over the next 7 years. This process could be UL weights to past figures for profitability, stability, and growth, and also for current financial condition. The second part of the analysis should consider to what extent the value based solely past performance should be modified because of new conditions expected in the future. On such a procedure would divide the work between senior and junior analysts as follows. 1. The senior analyst would set up the formula to apply to all companies generally for determining past performance value. 2. The junior analyst would work up such factors for the designated companies pretty much in mechanical fashion. 3. The senior analyst would then determine to what extent a company's performance, absolute or relative, is likely to differ from its past record and what change should be made in the value to reflect such anticipated changes. It would be best if the senior analyst report showed both the original valuation and the modified one with his reasons for the change. Is a job of this kind worth doing? Our answer is in the affirmative, but our reasons may appear somewhat cynical to the reader. We doubt whether the valuation so reached will prove sufficiently dependable in the case of the typical industrial company, great or small. We shall illustrate the difficulties of this job in our discussion of Aluminum Company of America, ALCOA, in the next chapter. Nonetheless, it should be done for such common stocks. Why? First, many security analysts are bound to make current or projected valuations as part of their daily work. The method we propose should be an improvement on those generally followed today. Secondly, because it should give useful experience and insight to the analysts who practice this method. Thirdly, because work of this kind could produce an invaluable body of recorded experience. as has long been the case in medicine, that to better methods of procedure and a useful knowledge of its possibilities and limitations. The public utility stocks might well prove an important area in which this approach will show real pragmatic value. Eventually, the intelligent analyst will confine himself to those groups in which the future appears reasonably may lead, predictable, or where the margin of safety of past performance value over current price is so large that he can take his chances on future variations, as he does in selecting well-secured senior securities. In subsequent chapters, we shall supply concrete examples of the application of analytical techniques, but they will only be illustrations. If the reader finds the subject interesting, he should pursue it systematically and thoroughly before he considers himself qualified to pass a final buy or sell judgment of his own on a security. Issue. Commentary on CHAPTER 11. Would you tell me, please, which way I ought to go from? Here? That depends a good deal on where you want to get to, said the cat. Lewis Carroll, Alice's Adventures in Wonderland, putting a price on the future which factors determine how much you should be willing to pay for a stock. What makes one company worth 10 times earnings and another worth 20 times? How can you be reasonably sure that you are not overpaying for an apparently rosy future that turns out to be a murky nightmare? Graham feels that 5 elements are decisive. He summarizes them as the company's general long-term prospects, the quality of its management, its financial strength and capital structure, its dividend record, and its current dividend rate. Let's look at these factors in the light of today's market, the long-term prospects. Nowadays, the intelligent investor should begin by downloading at least 5 years' worth of annual reports, Form 10K, from the company's website or from the EDGAR, mo.org.database at www.sec.gov. Then comb through the financial statements, gathering evidence to help you answer 2 overriding questions. What makes this company grow? Where do and where will its profits come from? Among the problems to watch for. The company is a serial acquirer. An average of more than 2 or 3 acquisitions a year is a sign of potential trouble. After all, if the company itself would rather buy the stock of other businesses than invest in its own, shouldn't you take the hint and look elsewhere too? And check the company's track record as an acquirer. Watch out for corporate bulimics firms that wolf down big acquisitions, only to end up vomiting them back out. Lucent, Mattel, Quaker Oats, and Tyco International are among the companies that have had to disgorge acquisitions at sickening losses. Other firms take chronic write-offs or accounting charges proving that they overpaid for their past acquisitions. That's a bad omen. For future deal-making. 3. The company is an OPM addict, borrowing debt or selling stock to raise boatloads of other people's money. These fat infusions of OPM are labeled cash from financing activities on the statement of cash flows in the annual report. They can make a sick company appear to be growing even if its underlying businesses are not generating enough cash, as Global Crossing and WorldCom showed not long ago. The company is a Johnny One Note, relying on one customer or a handful for most of its revenues. In October 1999, fiber optics maker Sycamore Networks, Inc. sold stock to the public for the first time. The prospectus revealed that one customer, Williams Communications, accounted for 100% of Sycamore's $11 million in total revenues. Traders blithely valued Sycamore shares at $15 billion. Unfortunately, Williams went bankrupt just over 2 years later. Although Sycamore picked up other customers, its stock lost 97% between 2000 and 2002. As you study the sources of growth and profit, stay on the lookout for positives as well as negatives. Among the good signs, the company has a wide moat or competitive advantage. Like castles, some companies can easily be stormed by marauding competitors, while others are almost impregnable. Several forces can widen a company's moat. A strong brand identity, think of Harley-Davidson, whose buyers tattoo the company's logo onto their bodies. A monopoly or near monopoly on the market, economies of scale, or the ability to supply huge amounts of goods or services cheaply, consider Gillette, which churns out razor blades by the billion. A unique intangible asset, think of Coca-Cola, whose secret formula for flavored syrup has no real physical value but maintains a priceless hold on consumers. A resistance to substitution. Most businesses have no alternative to electricity. So utility companies are unlikely to be supplanted anytime soon. Commentary. The company is a marathoner, not a sprinter. By looking back at the income statements, you can see whether revenues and net earnings have grown smoothly and steadily over the previous 10%. A recent article in the Financial Analyst Journal confirmed years. What other studies, and the sad experience of many investors, have shown that the fastest growing companies tend to overheat and flame out. If earnings are growing at a long-term rate of 10% pre-tax or 6% to 7% after tax, that may be sustainable. But the 15% growth hurdle that many companies set for themselves is delusional, and an even higher rate or a sudden burst of growth in 1 or 2 years is all but certain to fade, just like an inexperienced marathoner who tries to run the whole race as if it were a 100-meter dash. The company sows and reaps, no matter how good its products or how powerful its brands. A company must spend some money to develop new business. While research and development spending is not a source of growth today, it may well be tomorrow, particularly if a firm has a proven record of rejuvenating its businesses with new ideas and equipment. The average budget for research and development varies across industries and companies. In 2002, Procter & Gamble spent about 4% of its net sales on R&D, while 3M spent 6.5% and Johnson & Johnson 10.9%. In the long run, a company that spends nothing on R&D is at least as vulnerable as one that spends too much. The quality and conduct of management. A company's executives should say what they will do, then do what they said. Read the past annual reports to see what forecasts the managers made and if they fulfilled them or fell short. Managers should forthrightly admit their failures and take responsibility for them, rather than blaming all-purpose scapegoats like the economy, uncertainty, or weak demand. Check whether the tone and substance of the chairman's letters stay constant or fluctuate with the latest fads on Wall Street. Pay special attention to boom years like 1999. Did the executives of a cement or underwear company suddenly declare that they were on the leading edge of the transformative software revolution? These questions can also help you determine whether the people who run the company will act in the interests of the people who own the company. Are they looking out for number one? A firm that pays its CEO $100 million in a year had better have a very good reason. Perhaps he discovered and patented the fountain of youth, or found El Dorado and bought it for $1 an acre, or contacted life on another planet and negotiated a contract obligating the aliens to buy all their supplies from only one company on Earth. Otherwise, this kind of obscenely obese payday suggests that the firm is run by the managers, for the managers. If a company reprices or reissues or exchanges its stock options for insiders, stay away. In this switcheroo, a company cancels existing and typically worthless stock options for employees and executives, then replaces them with new ones at advantageous prices. If their value is never allowed to go to zero, while their potential profit is always infinite, how can options encourage good stewardship of corporate assets? Any established company that reprices options, as dozens of high-tech firms have, is a disgrace. And any investor who buys stock in such a company sheep begging to be sheared is by looking in the annual report for the mandatory footnote about stock options, you can see how large the option overhang is. AOL Time Warner, for example, reported in the front of its annual report that it had 4.5 billion shares of common stock outstanding as of December 31st, 2002. But a footnote in the bowels of the report reveals that the company had issued options on 657 million more shares. So AOL's future earnings will have to be divided among 15% more shares. You should factor in the potent teal flood of new shares from stock options whenever a company's future value you estimate. Form 4, available through the EDGAR database at www.cc. Gov shows whether a firm's senior executives and directors have been buying or selling shares. There can be legitimate reasons for an insider to sell diversification, a bigger house, a divorce settlement, but repeated big sales are a bright red flag. A manager can't legitimately be your partner if he keeps selling while you're buying. Are they managers or promoters? Executives should spend most of their time managing a company in private, not promoting it to the investing public. All too often, CEOs complain that their stock is undervalued, no matter how high it goes, forgetting Graham's insistence that managers should try to keep the stock price from going either too low or too high. Meanwhile, all too many chief financial officers give earnings guidance or guesstimates of the company's quarterly profits. And some firms are hypochondriacs, constantly spewing forth press releases boasting of temporary, trivial, or hypothetical opportunities. 8. A handful of companies, including Coca-Cola, Gillette, and USA Interactive, have begun to just say no to Wall Street's short-term thinking. These few brave outfits are providing more detail about their current budgets and long-term plans, while refusing to speculate about what the next 90 days might hold. For a model of how a company can communicate candidly and fairly with its shareholders, go to the EDGAR database at www.sec.gov and view the K filings made by Expeditors International of Washington, which periodically posts its superb question and answer dialogues with shareholders there. Finally, ask whether the company's accounting practices are designed to make its financial results transparent or opaque. If non-recurring charges keep recurring, extraordinary items crop up so often that they seem ordinary, acronyms like EBITDA take priority over net income, or pro forma earnings are used to cloak actual losses, you may be looking at a firm that has not yet learned how to put its shareholders' long-term interests first. Financial strength and beauty. Definition of a good business is this: it generates more cash than it consumes. Good managers keep finding ways of putting that cash to productive use. In the long run, companies that meet this definition are virtually certain to grow in value, no matter what the stock market does. Start by reading the statement of cash flows in the company's annual report. See whether cash from operations has grown steadily throughout the past 10 years. Then you can go further. Warren Buffett has popularized the concept of owner earnings, or net income plus amortization and depreciation minus normal capital expenditures. As portfolio manager Christopher Davis of Davis Selected Advisors puts it, if you owned 100% of this business, how much cash would you have in your pocket at the end of the year? Because it adjusts for accounting entries like amortization and depreciation that do not affect the company's cash balances. Owner earnings can be a better measure than reported net income. To fine-tune the definition of owner earnings, you should also subtract from reported net income 0. Any cost of granting stock options, which divert earnings away from existing shareholders into the hands of new inside owners. Any unusual, non-recurring, or extraordinary charges. Any income from the company's pension fund. If owner earnings per share have grown at a steady average of at least 6% or 7% over the past 10 years, the company is a stable generator of cash, and its prospects for growth are good. Next, look at the company's capital structure. Turn to the balance sheet to see how much debt, including preferred stock, the company has. In general, long-term debt should be under 50% of total capital. In the footnotes to the financial statements, determine whether the long-term debt is fixed rate with constant interest payments, able with payments that fluctuate, which could become costly if interest rates rise, or vari. Look in the annual report for the exhibit or statement showing the ratio of earnings to fixed charges. That exhibit to Amazon.com's 2002 annual report shows that Amazon's earnings fell $145 million short of covering its interest costs. In the future, Amazon will either have to earn much more from its operations or find a way to borrow money at lower rates. Otherwise, the company could end up being owned not by its shareholders, but by its bondholders, who can lay claim to Amazon's assets if they have no other way of securing the interest payments they are owed. To be fair, Amazon's ratio of earnings to fixed charges was far healthier in 2002 than 2 years earlier, when earnings fell $1.1 billion short of covering debt payments. A few words on dividends and stock policy. For more, please see Chapter 19. The burden of proof is on the company to show that you are better off if it does not pay a dividend. If the firm has consistently outperformed the competition in good markets and bad, The managers are clearly putting the cash to optimal use. If, however, business is faltering or the stock is underperforming its rivals, then the managers. And directors are misusing the cash by refusing to pay a dividend. Companies that repeatedly split their shares and hype those splits in breathless press releases treat their investors like dolts. Like Yogi Berra, who wanted his pizza cut into 4 slices because I don't think I can eat 8, the shareholders who love stock splits miss the point. 2 shares of a stock at $50 are not worth more than 1 share at $100. Managers who use splits to promote their stock are aiding and abetting the worst instincts of the investing public. And the intelligent investor will think twice before turning any money over to such condescending manipulators. 10. Companies should buy back their shares when they are cheap, when they are at or near record highs. Unfortunately, it recently has become all too common for companies to repurchase their stock when it is overpriced. There is no more cynical waste of a company's cash, since the real purpose of that maneuver is to enable top executives to reap multi-million-dollar paydays by selling their own stock options in the name of enhancing shareholder value. A substantial amount of anecdotal evidence, in fact, suggests that managers who talk about enhancing shareholder value seldom do. In investing, as with life in general, ultimate victory usually goes to the doers, not to the talkers. CHAPTER 12, things to consider about per share earnings. This chapter will begin with 2 pieces of advice to the investor that cannot avoid being contradictory in their implications. The first is, don't take a single year's earnings seriously. The second is, if you do pay attention to short-term earnings, look out for booby traps in the per share figures. If our first warning were followed strictly, the second would be unnecessary. But it is too much too. Expect that most shareholders can relate all their common stock decisions to the long-term record and the long-term prospects. The quarterly figures, and especially the annual figures, receive major attention in financial circles, and this emphasis can hardly fail to have its impact on the investor's thinking. He may well need some education in this area, for it abounds in misleading possibilities. As this chapter is being written, the earnings report of Aluminum Company of America, ALCOA, for 1970 appears in the Wall Street Journal. The first figures shown are 1970-1969. Share earnings 5.20 cents, 5.58. The little at the outset is explained in a footnote to refer to primary earnings before special charges. There's much more footnote material. In fact, it occupies twice as much space as do the basic figures themselves. For the December quarter alone, the earnings per share are given as $1.58 in 1970 against $1.56 in 1969. The investor or speculator interested in ALCOA shares reading those figures might say to himself, not so bad. I knew that 1970 was a recession year in aluminum. But the fourth quarter shows a gain over 1969, with earnings at the rate of $6.32 per year. Let me see. The stock is selling at 62%. Why, that's less than 10 times earnings. That makes it look pretty cheap, compared with 16 times for International Nickel, etc., etc. But if our investor speculator friend had bothered to read all the material in the footnote, he would have found that instead of 1 figure of earnings per share for the year 1970, there were actually 4, viz. 1970-1969. Primary earnings $5.20, 5.58 net income after special charges 4.3 to 5.58 fully diluted. Before special charges 5.01, 5.35 fully diluted. After special charges 4.19, 5.35. For the fourth quarter alone, only 2 figures are given. Primary earnings net income after special charges. What do all these additional earnings mean? Which earnings are true earnings for the year in the December quarter? If the latter should be taken at 70 cents, the net income after special charges annual rate would be $2.80 instead of $6. 32, and the price 62 would be 22 times earnings instead of the 10 times we started with. Part of the question as to the true earnings of ALCOA can be answered quite easily. The reduction from $5.20 to $5.01 to allow for the effects of dilution is clearly called for. ALCOA has a large bond issue convertible into common stock. to calculate the earning power of a common based on the 1,970 results. It must be assumed that the conversion privilege will be exercised if it should prove profitable to the bondholders to do so. The amount involved in the ALCOA picture is relatively small and hardly deserves detailed comment. But in other cases, making allowance for conversion rights and the existence of stock purchase warrants can reduce the apparent earnings by half or more. We shall present examples of a really significant dilution factor below, page 411. The financial services are not always consistent in their allowance for the dilution factor in their reporting and analyses. Let us turn now to the matter of special charges. This figure of $18,800,000 or 88 cents per share deducted in the fourth quarter is not unimportant. Is it to be ignored entirely or fully recognized as an earnings reduction or partly recognized and partly ignored? The alert investor might ask himself also, how does it happen that there was a virtual epidemic of such special charge-offs appearing after the close of 1970, but not in previous years? Could there possibly have been some fine Italian hands at work with the accounting, but always, of course, within the limits of the permissible? When we look closely, we may find that such losses charged off before they actually occur can be charmed away, as it were, with no unhappy effect on either past or future primary earnings. In some extreme cases, they might be availed of to make subsequent earnings appear nearly twice as large as in reality by a more or less prestigious treatment of the tax credit involved. In dealing with ALCOA special charges, the first thing to establish is how they arose. The footnotes are specific enough. The deductions came from four sources, viz. 1. Management's estimate of the anticipated costs of closing down the manufactured products division. 2. Ditto for closing down ALCOA Castings Company's plants. 3. Ditto for losses in phasing out ALCOA Credit Company 4. Also estimated costs of $5.3 million associated with Compal, shand of the contract for a curtain wall. All of these items are related to future costs and losses. It is easy to say that they are not part of the regular operating results of 1970, but if so, where do they belong? Are they so extraordinary and non-recurring as to belong nowhere? A widespread enterprise such as ALCOA doing a $1.5 billion business annually must have a lot of divisions, departments, affiliates, and the like, would it not? Be normal rather than extraordinary for one or more to prove, unprofitable, and to require closing down. Similarly for such things as a contract to build a wall. Suppose that any time a company had a loss on any part of its business, it had the bright idea of charging it off as a special item, and thus reporting its primary earnings per share so as to include only its profitable contracts and operations. Like King Edward VII's sundial, that marked only the sunny hours. 11. The reader should note two ingenious aspects of the ALCOA procedure we have been discussing. The first is that by anticipating future losses the company escapes, the necessity of allocating the losses themselves to an identifiable year. They don't belong in year, and they, 1970, because they were not actually taken. In that, won't be shown in the year when they're actually taken because they have already been provided for. Neat work, but might it not be just a little misleading? The ALCOA footnote says nothing about the future tax saving from these losses. Most other statements of this sort state specifically that only the after-tax effect has been charged off. If the ALCOA figure represents future losses before the related tax credit, then not only will future earnings be freed from the weight of these charges as they are actually incurred, but they will be increased by a tax credit of some 50% thereof. It is difficult to believe that the accounts will be handled that way, but it is a fact that certain companies which have had large losses in the past have been able to report future earnings without charging the normal taxes against indemnum, in that way making a very fine profits appearance based paradoxically enough on their past disgraces. Tax credits resulting from past year's losses are now being shown separately as special items, but they will enter into future statistics as part of the final net income figure. However, a reserve now set up future losses, if net of expected tax credit, should not create an addition of this sort to the net income of later years. 4. The other ingenious feature is the use by ALCOA and many other companies of the 1970 year end for making these special charge-offs. The stock market took what appeared to be a bloodbath in the first half of 1970. Everyone expected relatively poor results for the year for most companies. Wall Street was now anticipating better results in 1971, 1972, etc. What a nice arrangement then. To charge as much as possible to the bad already been written off mentally and had virtually receded into the past, leaving the way clear for nicely fattened figures in the next few years. Perhaps this is good accounting, good business pull, I see, and good for management-shareholder relationships. But we have lingering doubts, year which had. The combination of widely, or should it be wildly, diversified operations with the impulse to clean house at the end of 1970 has some strange-looking footnotes to the annual reports produced. The reader may be amused by the following explanation given by a New York Stock Exchange company, which shall remain unnamed, of its special items aggregating $2. $357,000, or about a third of the income before charge-offs. Consists of provision for closing Spalding United Kingdom operations, provision for reorganizational expenses of a division, cost of selling a small baby pants and bib manufacturing company, disposing of part interest in a Spanish car leasing facility, and liquidation of a ski boot operation. Years ago, the strong companies used to set up contingency reserves out of the profits of good years to absorb some of the bad effects of depression years to come. The underlying idea was to equalize the reported earnings more or less and to improve the stability factor in the company's record. A worthy motive, it would seem, but the accountants quite rightly objected to the practice as misstating the true earnings. They insisted that each year's results be presented as they were, good or bad, and the shareholders and analysts be allowed to do the averaging or equalizing for themselves. We seem now to be witnessing the opposite phenomenon, with everyone charging off as much as possible against forgotten 1970, so as to start 1971 with a slate not only clean, but specially prepared to show pleasing per-share figures in the coming years. It is time to return to our first question. What then were the true earnings of ALCOA in 1970? The accurate answer would be the $5.01 per share after dilution, less that part of the 82 cents of special charges that may properly be attributed to occurrences in 1970. But we do not know what that portion is, and hence we cannot properly state the true earnings for the year. The management and the auditors should have given us their best judgment on this point, but they did not do so. And furthermore, the management and the auditors should have provided for deduction of the balance of these charges from the ordinary earnings of a suitable number of. Future years say not more than 5. This evidently they will not do either, since they have already conveniently disposed of the entire sum as a 1970 special charge. The more seriously investors take the per-share earnings figures as published, the more necessary it is for them to be on their guard against accounting factors of one kind and another that may impair the true comparability of the numbers. We have mentioned 3 sorts of these factors: the use of special charges, which may never be reflected in the per-share earnings, the reduction in the normal income tax deduction by reason of past losses, and the dilution factor, or implicit in the existence of substantial amounts of convertible securities or warrants. A fourth item that has had a significant effect on reported earnings in the past is the method of treating depreciation, chiefly as between the straight line and the accelerated schedules. We refrain from details here, but as an example current as we write, let us mention the 1970 report Train Company. This firm showed an increase of nearly 20% in per share earnings over 1969 through $3.29 versus $2.76, but half of this came from returning to the older straight-line depreciation rates, less burdensome on earnings than the accelerated method used the year before. The company will continue to use the accelerated rate on its income tax return, thus deferring income tax payments on the difference. Still another factor, important at times, is the choice between charging off research and development costs in the year they are incurred or amortizing them over a period of years. Finally, let us mention the choice between the FIFO, first in first out, and LIFO, last in first out, methods of valuing inventories. An obvious remark here would be that investors should not pay any attention to these accounting variables if the amounts involved are relatively small. But Wall Street being as it is, even items quite minor in themselves can be taken seriously. 2 days before the ALCOA report appeared in the Wall Street Journal, the paper had quite a discussion of the corresponding statement of Dow Chemical. It closed with the observation that many analysts had been troubled by the fact that Dow had included a 21-cent item in regular profits for 1969, instead of treating it as an item of extraordinary income. Why the fuss? Because evidently, evaluations of Dow Chemical involving many millions of dollars in the aggregate seemed to depend on exactly what was the percentage gain for 1969 over 1968, in this case either 9% or 4%. This strikes us as rather absurd. It is very unlikely that small differences involved in one year's results could have any bearing on future average profits or growth, and on a conservative, realistic valuation of the enterprise. By contrast, consider another statement also appearing in January 1971. This concerned Northwest Industries Inc.'s report for 1970. The company was planning to write off as a special charge not less than $264 million in one fell swoop. Of this, $200 million represents the loss to be taken on the proposed sale of the railroad subsidiary to its employees, and the balance a write-down of a recent stock purchase. These sums would work out to a loss of about $35 per share of common before dilution offsets, or twice its then current market price. Here we have something really signify. Can't, if the transaction goes through and if the tax laws are not changed. This loss provided for in 1970 will permit Northwest Industries to realize about $400 million of future profits within 5 years from its other diversified interests without paying income tax thereon. What will then be the real earnings of that enterprise? Should they be calculated with or without provision for the nearly 50% in income taxes which it will not actually have to pay? In our opinion, the proper mode of calculation would be first to consider the indicated earning power on the basis of full income tax liability, and to derive some broad idea of the stock's value based on that estimate. To this should be added some bonus figure representing the value per share of the important but temporary tax exemption the company will enjoy. Allowance must be made also for a possible large-scale dilution in this case. Actually, the convertible preferred issues and warrants would more than double the outstanding common shares if the privileges are exercised. All this may be confusing and wearisome to our readers, but it belongs in our story. Corporate accounting is often tricky. Security analysis can be complicated. Stock valuations are really dependable only in exceptional cases. For most investors, it would be probably best to assure themselves that they are getting good value for the prices they pay and let it go at that. Use of average earnings. In former times, analysts and investors paid considerable attention to the average earnings over a fairly long period in the past, usually from 7 to 10 years. This mean figure was useful for ironing out the frequent ups and downs of the business cycle, and it was thought to give a better idea of the company's earning power than the results of the latest year alone. One important advantage of such an averaging process is that it will solve the problem of what to do about nearly all the special charges and credits. They should be included in the average earnings, for certainly most of these losses and gains represent a part of the company's operating history. If we do this for a LCOA, the average earnings for 1961 to 1970, 10 years, would appear as $3.62 and $4. The 7 years 1964 to 1970 is $4.62 per share. If such figures are used in conjunction with ratings for growth and stability of earnings during the SAME period, they could give a really informing picture of the company's past performance, calculation of the past growth rate. It is of prime importance that the growth factor in a company's record be taken adequately into account. Where the growth has been large, the recent earnings will be well above the 7 or 10-year average, and analysts may deem these long-term figures irrelevant. This need not be the case. The earnings can be given in terms both of the average and the latest figure. We suggest that the growth rate itself be calculated by comparing the 3 years with corresponding figures 10 years earlier. Where there is a problem of special charges or credits, it may be dealt with on some compromise basis. Note the following calculation for the growth of ALCOA as against that of Sears Roebuck and the DJI group as a whole. Average of the last. Comment: these few figures could be made the subject of a long discussion. They probably show, as well as any others, derived by elaborate mathematical treatment, the actual growth of earnings for the long period 1958 to 1970. But how relevant is this? Figure generally considered central and common stock valuations to the case of ALCOA. Its past growth rate was excellent, actually. Bit better than that of acclaimed Sears Roebuck and much higher than that of the DJI, a composite. But the market price at the beginning of 1971 seemed to pay no attention to this fine performance. ALCOA sold at only 111.2 times the recent 3-year average, while Sears sold at 27 times and the DJI itself at 15 plus times. How did this come about? Evidently, Wall Street has fairly pessimistic views about the future course of ALCOA's earnings, in contrast with its past record. Surprisingly enough, the high price for ALCOA was made as far back as 1959. In that year, it sold at 116 or 45 times its earnings. This compares with a 1959 adjusted high price of 25% for Sears Roebuck, or 20 times then earnings. Even though ALCOA's profits did show excellent growth thereafter, it is evident that in this case, the future possibilities were greatly overestimated in the market price. It closed 1970 at exactly half of the 1959 high, while Sears tripled in price and the DJI moved up nearly 30%. It should be pointed out that ALCOA's earnings on capital funds had been only average or less. And this may be the decisive factor here. High multipliers have been maintained in the stock market only if the company has maintained better than average profitability. www.lo.org. Let us apply at this point to Alcoa the suggestion we made in the previous chapter for a two-part appraisal process. Approach might have produced a past performance value for ALCOA of 10% of the DJIA, or $84 per share relative to the closing price of $840 for the DJIA in 1970. On this basis, the shares would have appeared quite attractive at their price of 57%. To what extent should the senior analyst have marked down the past performance value to allow for adverse developments that he saw in the future? Frankly, we have no idea. Assume he had reason to believe that the 1971 earnings would be as low as $2.50 per share, a large drop from the 1970 figure. As against an advance expected for the DJIA, very likely the stock market would take this poor performance quite seriously, but would it really establish the once mighty aluminum company of America as a relatively unprofitable enterprise to be valued at less than its tangible assets? Behind the shares, in 1971, the price declined from a high of 70 in May to a low of 36 in December against a book value of 55. ALCOA is surely a representative industrial company of huge size, but we think that its price and earnings history is more unusual, even contradictory than that of most other large enterprises. Yet this instance supports to some degree the doubts we expressed in the last chapter as to the dependability of the appraisal procedure when applied to the typical industrial company, COMMENTARY on CHAPTER 12. You can get ripped off easier by a dude with a pen than you can by a dude with a gun. Bo Diddley. The numbers game. Even Graham would have been startled by the extent to which companies and their accountants pushed the limits of propriety in the past few years. Compensated heavily through stock options, top executives realized that they could become fabulously rich merely by increasing their company's earnings for just a few years running. Hundreds of companies violated the spirit, if not the letter, of accounting principles, turning their financial reports into gibberish, tarting up ugly results with cosmetic fixes, cloaking expenses, or manufacturing earnings out of thin air. Let's look at some of these unsavory practices. As if perhaps the most widespread bit of accounting hocus pocus was the pro forma earnings fad. There's an old saying on Wall Street that every bad idea starts out as a good idea, and pro forma earnings presentation is no different. The original point was to provide a truer tour of the long-term growth of earnings by adjusting for short-term deviations from the trend or for supposedly non-recurring events. A pro forma press release might, for instance, show what a company would have earned over the past year if another firm it just acquired had been part of the family for the entire 12 months. But as the naughty 1990s advanced, companies just couldn't leave well enough alone. Just look at these examples of pro forma flimflam. For the quarter ended September 30th, 1999, InfoSpace Inc. presented its pro forma earnings as if it had not paid $159.9 million in preferred stock dividends. For the quarter ended October 31st, 2001, BEA Systems Inc. presented its pro forma earnings as if it had not paid $193 million in payroll taxes on stock options exercised by its employees. For the quarter ended March 31st, 2001, JDS Uniphase Corp. presented its pro forma earnings as if it had not paid $4 million in payroll taxes, had not lost $7 million investing in lousy stocks, and had not incurred $2.5 billion in charges related to mergers and goodwill. In short, pro forma earnings enable companies to show how well they might have done if they hadn't done as badly as they did. As an intelligent investor, the only thing you should do with pro forma earnings is ignore them. Hungry for recognition. In 2000s, Qwest Communications International Inc., the telecommunications giant, looked strong. Its shares dropped less than 5%, even as the stock market lost more than 9% that year. But Qwest's financial reports held an odd little revelation. In late 1999, Qwest decided to recognize the revenues from its telephone directories as soon as the phone books were published, even though, as anyone who has ever taken out a Yellow Pages advertisement knows, many businesses pay for those ads in monthly installments. Abracadabra! That piddly-sounding change in accounting principle pumped up 1999 net income by $240 million after taxes a fifth of all the money Qwest earned that year. Like a little chunk of ice crowning a submerged iceberg, aggressive revenue recognition is often a sign of dangers that run deep and loom large, and so it was at Qwest. By early 2003, after reviewing its previous financial statements, the company announced that it had prematurely recognized profits on equipment sales, improperly recorded the costs of services provided by outsiders, inappropriately booked costs as if they were capital assets rather than expenses, and unjustifiably treated the exchange of assets as if they were outright sales. All told, Qwest revenues for 2000s and 2001 had been overstated by $2.2 billion, including $80 million from the earlier change in accounting principle, which was now reversed. 3. Capital offenses. In the late 1990s, Global Crossing Limited had unlimited ambitions. The Bermuda-based company was building what it called the first integrated global fiber optic network over more than 100,000 miles of www.lo.org. cables, largely laid across the floor of the world's oceans. After wiring the world, Global Crossing would sell other communications companies the right to carry their traffic over its network of cables. In 1998 alone, Global Crossing spent more than $600 million to construct its optical web. That year, nearly a third of the construction budget was charged against revenues as an expense called cost of capacity sold. If not for that $178 million expense, Global Crossing, which reported a net loss of $96 million, could have reported a net profit of roughly $82 million. The next year, says a bland footnote in the 1999 annual report, Global Crossing initiated service contract accounting. The company would no longer charge most construction costs as expenses against the immediate revenues it received from selling capacity on its network. Instead, a major chunk of those construction costs would now be treated not as an operating expense, but as a capital expenditure, thereby increasing the company's total assets, instead of decreasing its net income. Poof! In one wave of the wand, Global Crossing's property and equipment assets rose by $1 million, while its cost of sales increased by a mere $1 million, even though the company was spending money like a drunken sailor. Capital expenditures are an essential tool for managers to make a good business grow bigger and better. But malleable accounting rules permit managers to inflate reported profits by transforming operating expenses into capital assets. As the Global Crossing case shows, the intelligent investor should be sure to understand what and why a company capitalizes. An inventory story like many makers of semiconductor chips, Micron Technology, Inc., suffered a drop in sales after. In fact, Micron was hit so hard by the plunge in demand that it had to start writing down the value of its inventories, since customers clearly did not want them at the prices Micron had been asking. In the quarter ended May 2001, Micron slashed the recorded value of its inventories by $261 million. Most investors interpreted the write-down not as a normal or recurring cost of operations, but as an unusual event. But look what happened after that. Micron booked further inventory write-downs in every one of the next 6 fiscal quarters. Was the devaluation of Micron's inventory a non-recurring event, or had it become a chronic condition? Reason. Able minds can differ on this particular case, but one thing is clear: the intelligent investor must always be on guard for non-recurring costs that, like the Energizer Bunny, just keep on going. The PENSIONDIMENSION. In 2001, SBC Communications Inc., which owns interests in Singular Wireless, Pactel, and Southern New England Telephone, earned $7.2 billion in net income, a stellar performance in a bad year for the overextended telecom industry. But that gain didn't come only from SBC's business. Fully $1.4 billion of it, 13% of the company's net. Income came from SBC's pension plan, because SBC had more money in the pension plan than it estimated was necessary to pay its employees future benefits. The company got to treat the difference as current income. One simple reason for that surplus. In 2001, SBC raised the rate of return it expected to earn on the pension plan's investments from 8.5% to 9.5%, lowering the amount of money it needed to set aside today. SBC explained its rosy new expectations by noting that for each of the 3 years ended 2001, our actual 10-year return on investments exceeded 10%. In other words, our past returns have been high, so let's assume that our future returns will be too. But that not only flunked the most rudimentary tests of logic, it flew in the face of the fact that interest rates were falling to near record lows, depressing the future returns on the bond portion of a pension portfolio. The same year, in fact, Warren Buffett's Berkshire Hathaway lowered the expected rate of return on its pension assets from 8.3% to 6.5%. Was SBC being realistic in assuming that its pension fund managers could significantly outperform the world's greatest investor? Probably not. In 2001, Berkshire Hathaway's pension fund gained 9.8%, but SBC's pension fund lost 6.9%. Here are some quick considerations for the intelligent investor. Is the net pension benefit more than 5% of the company's net income? If so, would you still be comfortable with the company's other earnings if those pension gains went away in future years? Is the assumed long-term rate of return on plan assets reasonable? As of 2003, anything above 6.5% is implausible, while a rising rate is downright delusional. Caveat investor. A few pointers will help you avoid buying a stock that turns out to be an accounting time bomb, read backwards. When you research a company's financial reports, start reading on the last page and slowly work your way toward the front. Anything that the company doesn't want you to find is buried in the back, which is precisely why you should look there. First, read the notes. Never buy a stock without reading the footnotes to the financial statements in the annual report. Usually labeled summary of significant accounting policies, one key note describes how the company recognizes revenue, records inventories, treats installment or contract sales, expenses its marketing costs, and accounts for the other major aspects of its business. In the other footnotes, watch for disclosures about debt, stock options, loans to customers, reserves against losses, and other risk factors that can take a big chomp out of earnings. Among the things that should make your antennae twitch are technical terms like capitalized, deferred, and restructuring, in plain English words signaling that the company has altered its accounting practices like began, change, and however. None of those words mean you should not buy the stock, but all mean that you need to investigate further. Be sure to compare the footnotes with those in the financial statements of at least one firm that's a close competitor to see how aggressive your company's accountants are. Read more. If you are an enterprising investor willing to put plenty of time and energy into your portfolio, then you owe it to yourself. 2. Learn more about financial reporting. That's the only way to minimize your odds of being misled by a shifty earnings statement. 3. Solid. Books full of timely and specific examples are Martin, Fritzen, and Fernando Alvarez's financial statement analysis, Charles Mulford, and Eugene Comiskey's The Financial Numbers Game, and Howard Schillett's Financial Shenanigans. Chapter 13 Rants, a comparison of 4 listed companies. In this chapter, we should like to present a sample of security analysis in operation. We have selected, more or less at random, 4 companies which are found successively on the New York Stock Exchange list. These are ELTRA Corp., a merger of Electric Autolite and Mergenthaler Linotype Enterprises, Emerson Electric Company, a manufacturer of electric and electronic products, Embraer Freight, a domestic forwarder of air freight, and Emhart Corp., originally a maker of bottling machinery only, but now also in builder's hardware. There are some broad resemblances between the 3 manufacturing firms, but the differences will seem more significant. There should be sufficient variety in the financial and operating data to make the examination of interest. In Table 13-1, we present a summary of what the 4 companies were selling for in the market at the end of 1970 and a few figures on their 1970 operations. We then detail certain key ratios which relate on the one hand to performance and on the other to price. Comment is called for on how various aspects of the performance pattern agree with the relative price pattern. Finally, we show the 4 companies in review, suggesting some comparisons. Passant. Relationships and evaluating each in terms of the requirements. Conservative common stock investor. The most striking fact about the 4 companies is that the current price earnings ratios vary much more widely than their operating performance or financial condition. 2 of the enterprises, ELTRA and Emhart, were modestly priced at only 9.7 times and 12 times the average earnings for 1968 to 1970. As against A, similar figure of 15.5 times for the DJIA, the other 2 Emerson. And Emory showed very high multiples of 33 and 45 times such earnings. There is bound to be some explanation of a difference, such as this, and it is found in the superior growth of the favored company's profits in recent years, especially by the freight for Warder. But the growth figures of the other 2 firms were not unsatisfactory. For more comprehensive treatment, let us review briefly the chief elements of performance as they appear from our figures. A comparison of 4 LCU. Compan 1. Profitability. A. All the companies show satisfactory earnings on their book value, but the figures for Emerson and Emory are much higher than for the other 2. A high rate of return on invested capital often goes along with a high annual growth rate in earnings per share. All the companies except Emory showed better earnings on book value in 1969 than in 1961, but the Emory figure was exceptionally large in both years. B. For manufacturing companies, the profit figure per dollar of sales is usually an indica, shown of comparative strength or weakness. We use here the ratio of operating income to sales as given in Standard & Poor's listed stock reports. Here again, the results are satisfactory for all 4 companies, with an especially impressive showing by Emerson. The changes between 1961 and 1969 vary considerably among the companies. 2. Stability. This we measure by the maximum decline in per-share earnings in any one of the past 10 years, as against the average of 3 preceding years. No decline translates into 100% stability, and this was registered by the 2 popular concerns. But the shrinkages of ELTRA and Emhart were quite moderate in the poor year 1970, amounting to only 8% each by our measurement, against 7% for the DJIA. 3. Growth. The 2 low multiplier companies show quite satisfactory growth rates, in both cases doing better than the Dow Jones Group. The ELTRA figures are especially impressive when set against its low price earnings ratio. The growth is of course more impressive for the high multiplier pair. 4. Financial position. The 3 manufacturing companies are in sound financial condition, having better than the standard ratio of $2 of current assets for $1 of current liabilities. Emery Air Freight has a lower ratio, but it falls in a different category, and with its fine record, it would have no problem raising needed cash. All the companies have relatively low long-term debt. Dilution note: Emerson Electric had $163 million of market value of low dividend. Convertible preferred shares outstanding at the end of 1970. In our analysis, we've made allowance for the dilution factor in the usual way by treating the preferred as if converted into common. This decreased recent earnings by about 10 cents per share, some 4%. 5. Dividends. What really counts is the history of continuance without interruption. The best record here is Emhart's, which has not suspended a payment since 1902. ELTRA's record is very good. Emerson's quite satisfactory. Emery Freight is a newcomer. The variations in payout percentage do not seem especially significant. The current dividend yield is twice as high on the cheap pair as on the dear pair, corresponding to the price-earnings ratios. 6 cent price history. The reader should be impressed by the percentage advance shown in the price of all four of these issues, as measured from the lowest to the highest points during the past 34 years. In all cases, the low price has been adjusted for subsequent stock splits. Note that for the DJIA, the range from low to high was on the order of 11 to 1. For our companies, the spread has varied from only 17 to 1 for Emhart to no less than 528 to 1 for Emery Air Freight. These manifold price advances are characteristic of most of our older common stock issues, and they proclaim the great opportunities of profit that have existed in the stock markets of the past. But they may indicate also how overdone were the declines in the bear markets before 1950, when the low prices were registered. Both ELTRA and Emhart sustained price shrinkages of more than 50% in the 1969.70 price break. Emerson and Emery had serious, but less distressing, declines. The former rebounded to a new all-time high before the end of 1970, the latter in early 1971. General observations on the four companies. Emerson Electric has an enormous total market value, dwarfing the other three companies combined. It is one of our goodwill giants, to be commented on later. A financial analyst blessed or handicapped with a good memory will think of an analogy between Emerson Electric and Zenith Radio, and that would not be reassuring, for Zenith had a brilliant growth record for many years. It too sold in the market for $1.7 billion in 1966, but its profits fell from $43 million in 1968 to only half as much in 1970, and in that year's big sell-off, its price declined to $221.2 against the previous top of $89. High valuations entail high risks. Emery Air Freight must be the most promising of the four companies in terms of future growth. If the price-earnings ratio of nearly 40 times its highest reported earnings is to be even partially justified. The past growth, of course, has been most impressive, but these figures may not be so significant for the future if we consider that they started quite small, at only $570,000 of net earnings in 1958. It often proves much more difficult to continue to grow at a high rate after volume and profits have already expanded to big totals. The most surprising aspect of Emery's story is that its earnings and market price continued to grow apace in 1970, which was the worst year in the domestic air passenger industry. This is a remarkable achievement indeed, but it raises a question whether future profits may not be vulnerable to adverse developments through increased competition, pressure for new arrangements between forwarders and airlines, etc. An elaborate study might be needed before a sound judgment could be passed on these points. But the conservative investor cannot leave him out of his general reckoning. Emhart and ELTRA. Emhart has done better in its business than in the stock market over the past 14 years. In 1958, it sold as high as 22 times the current earnings, about the same ratio as for the DJIA. Since then, its profits tripled, as against a rise of less than 100% for the Dow, but its closing price in 1970 was only a third above the INDECE 1958 high versus 43% for the Dow. The record of ELTRA is somewhat similar. It appears that neither of these companies possesses glamour or sex appeal in the present market. But in all the statistical data, they show up surprisingly well. Their future, pros, pecs, we have no sage remarks to make here. But this is what Standard & Poor's had to say about the four companies. In 1971, ELTRA, long-term prospects, certain operations are cyclical, but an established competitive position and diversification are offsetting factors. Emerson Electric, while adequately priced at 71 on the current outlook, the shares have appeal for the long term, a continued acquisition policy together with a strong position in industrial fields and an accelerated international program suggests further sales and earnings progress. Emery Air Freight, the shares appear amply priced at 57 on current rent prospects, but are well worth holding for the long pull. Emhart, although restricted this year by lower capital spending in the glass container industry, earnings should be aided by an improved business environment in 1972. The shares are worth holding at 34. Conclusions. Many financial analysts will find Emerson and Emery more interesting and appealing stocks than the other two, primarily perhaps because of their better market action, and secondarily because of their faster recent growth in earnings. Under our principles of conservative investment, the first is not a valid reason for selection, that is something for the speculators to play around with. The second has validity, but within limits. Can the past growth and the presumably good prospects of Emery Air Freight justify a price more than 60 times its recent earnings? Our answer would be maybe for someone who has made an in-depth study of the possibilities of this ant company, shallowly firm and optimistic conclusions. But not for the careful investor who wants to be reasonably sure in advance that he is not committing the typical Wall Street error of overenthusiasm for good performance in earnings and in the stock market. The same. Come up with except. Cautionary statements seem called for in the case of Emerson Electric, with a special reference to the market's current valuation of over $1 billion for the intangible or earning power factor here. We should add that the electronics industry, once a fair-haired child of the stock market, has in general fallen on disastrous days. Emerson is an outstanding exception, but it will have to continue to be such an exception for a great many years in the future before the 2,970 closing price will have been fully justified by its subsequent performance. By contrast, both ELTRA at 27 and Emhart at 33 have the earmarks of companies with sufficient value behind their price to constitute reasonably protected investments. Here the investor can, if he wishes, consider himself basically a part owner of these businesses, at a cost corresponding to what the balance sheet shows to be the money invested therein. The rate of earnings on invested capital has long been satisfactory. The stability of profits also, the past growth rate, surprisingly so. The two companies will meet our 7 statistical requirements for inclusion in a defensive investor's portfolio. These will be developed in the next chapter, but we summarize them as follows. 1. Adequate size. 2. A sufficiently strong financial condition. 3. Continued dividends for at least the past 20 years. 4. No earnings deficit in the past 10 years. 5%. 10-year growth of at least 1/3 in per-share earnings. 6%. For stock no more than 11.2 times net asset value. 7. Price no more than 15 times average earnings of the past 3 years. We make no predictions about the future earnings performance of ELTRA or Emhart. In the investor's diversified list of common stocks, there are bound to be some that prove disappointing, and this may be the case for one or both of this pair. But the diversified list itself, based on the above principles of selection, plus whatever other sensible criteria the investor may wish to apply, should perform well enough across the years. At least long experience tells us so. A final observation. An experienced security analyst, even if he accepted our general reasoning on these 4 companies, would have hesitated to recommend that a holder of Emerson or Emery exchange his shares for ELTRA or Emhart at the end of 1970, unless the holder understood clearly the philosophy behind the recommendation. There was no reason to expect that in any short period of time the low multiplier duo would outperform the high multipliers. The latter were well thought of in the market and thus had a considerable degree of momentum behind them, which might continue for an indefinite period. The sound basis for preferring ELTRA and MHART to Emerson and Emery would be the client's considered conclusion that he preferred value-type investments to glamour-type investments. Thus, to a substantial extent, common stock investment policy must depend on the attitude of the individual investor. This approach is treated at greater length in our next chapter. Commentary on Chapter 13, Rands, Flies. In the Air Force, we have a rule. Check 6. A guy is flying along, looking in all directions, and feeling very safe. Another guy. Up behind him at 6 o'clock, 12 o'clock is directly in front and shoots. Most airplanes are shot down that way, thinking that you're safe is very dangerous. Somewhere there's a weakness you've got to find. You must always check 6 o'clock. U.S. Air Force General Donald Kutina, EBUSINESS. As Graham did, let's compare and contrast 4 stocks, using their reported numbers as of December 31. 1999, a time that will enable us to view some of the most drastic extremes of valuation ever recorded in the stock market. Emerson Electric Company, ticker symbol EMR, was founded in 1890 and is the only surviving member of Graham's original quartet. It makes a wide array of products, including power tools, air, conditioning equipment, and electrical motors. EMC Corp., ticker symbol EMC, dates back to 1979 and enables companies to automate the storage of electronic information over computer networks. Expeditors International of Washington, Inc., ticker symbol EXPD, founded in Seattle in 1979, helps shippers organize and track the movement of goods around the world. Exodus Communications, Inc., ticker symbol EXDS, hosts and manages websites for corporate customers. Along with other internet services, it first sold shares to the public in March 1998. This table summarizes the price, performance, and valuation of these companies as of year-end 1999. ELECTRIC, not ELECTRIFYING. The most expensive of Graham's 4 stocks, Emerson Electric, ended up as the cheapest in our updated group. With its base in old economy industries, Emerson looked boring in the late 1990s. In the internet age, who cared about Emerson's heavy-duty wet-dry vacuums? The company's shares went into suspended animation in 1998 and 1999. Emerson's stock lagged the S&P 500 index by a cumulative 49.7 percentage points, a miserable underperformance. But that was Emerson, the stock. What about Emerson, the company? In 1999, Emerson sold $14.4 billion worth of goods and services, up nearly $1 billion from the year before. On those revenues, Emerson earned $1.3 billion in net income, or 6.9% more than in 1998. Over the previous 5 years, earnings per share had risen at a robust average rate of 8.3%. Emerson's dividend had more than doubled to $1.30 per share. Book value had gone from $6.69 to $14.27 per share. According to Value Line, throughout the 1990s, Emerson's net profit margin and return on capital, key measures of its efficiency as a business, had stayed robustly high, around 9% and 18% respectively. What's more, Emerson had increased its earnings for 42 years in a row and had raised its dividend for 43 straight years, one of the longest runs of steady growth in American business. At year-end, Emerson's stock was priced at 17.7 times the company's net income per share. Like its power tools, Emerson was never flashy, but it was reliable and showed no sign of overheating. Could EMC grow PDQ? EMC Corp. was one of the best performing stocks of the 1990s, rising, or should we say levitating, more than 81,000%. If you had invested $10,000 in EMC stock at the beginning of 1990, you would have ended 1999 with just over $8.1 million. EMC shares returned 157.1% in 1999 alone, more than Emerson's stock had gained in the 8 years from 1992 through 1999 combined. EMC had never paid a dividend, instead retaining all its earnings to provide funds for the continued growth of the company. at their December 31 price of $54.625. EMC's shares were trading at 103 times the earnings the company would report for the full year, nearly 6 times the valuation level of Emerson's stock. What about EMC, the business? Revenues grew 24% in 1999, rising to $6.7 billion. Its earnings per share soared to 92 cents from 61 cents the year before, a 51% increase. Over the 5 years ending in 1999, EMC's earnings had risen at a sizzling annual rate of 28.8%. And with everyone expecting the tidal wave of internet commerce to keep rolling, the future looked even brighter. Throughout 1999, EMC's chief executive repeatedly predicted that revenues would hit $10 billion by 2001, up from $5.4 billion in 1,998.2%. That would require average annual growth of 23%, a monstrous rate of expansion for so big a company. But Wall Street's analysts and most investors were sure EMC could do it. After all, over the previous 5 years, EMC had more than doubled its revenues and better than tripled its net income. But from 1995 through 1999, according to Value Line, EMC's net profit margin slid from 19% to 17.4%, while its return on capital dropped from 26.8% to 21%. Although still highly profitable, EMC was already slipping. And in October 1999, EMC acquired Data General Corp., which added roughly $1.1 billion to EMC's revenues that year, simply by subtracting the extra revenues brought in from Data General. We can see that the volume of EMC's existing businesses grew from $5.4 billion in 1998 to just $5.6 billion in 1999, a rise of only 3.6%. In other words, EMC's true growth rate was almost -11 in a year when the scare over the Y2K computer bug had led many companies to spend record amounts on new technology. .3. A simple twist of FREIGHT. Unlike EMC, Expeditors International hadn't yet learned to levitate. Although the firm's shares had risen 30% annually in the 1990s, much of that big gain had come at the very end, as the stock raced to a 109.1% return in 1999. The year before, Expeditors shares had gone up just 9.5%, trailing the S&P 500 index by more than 19 percentage points. What about the business? Expeditors was growing expeditiously indeed. Since 1995, its revenues had risen at an average annual rate of 19.8%, nearly tripling over the period to finish 1999 at $1.4 billion. And earnings per share had grown by 25.8% annually, while dividends had risen at a 27% annual clip. Expeditors had no long-term debt, and its working capital had nearly doubled since 1995. According to Value Line, Expeditors' book value per share had increased 129%, and its return on capital had risen by more than 1/3 to 21% by any standard. Expeditors was a superb business. But the little freight forwarding company, with its base in Seattle and much of its operations in Asia, was all but unknown on Wall Street. Only 32% of the shares were owned by institutional investors. In fact, Expeditors had only 8,500 shareholders. After doubling in 1999, the stock was priced at 39 times the net income Expeditors would earn for the year, no longer anywhere near cheap, but well below the vertiginous valuation of EMC. The promised land? By end of 1999, Exodus Communications seemed to have taken its shareholders straight to the land of milk and honey. The stock soared 1,005.8% in 1999, enough to turn a $10,000 investment on January 1st into more than $110,000 by December 31st. Wall Street's leading internet stock analysts, including the hugely influential Henry Blodgett of Merrill Lynch, were predicting that the stock would rise another 25% to 125% over the coming year. And best of all, in the eyes of the online traders who gorged on Exodus's gains, was the fact that the stock had split 2-4-1-3 times during 1999. In a 2-for-1 stock split, a company doubles the number of its shares and halves their price, so a shareholder ends up owning twice as many shares, each priced at half the former level. What's so great about that? Imagine that you handed me a dime and I then gave you back 2 nickels and asked, "Don't you feel richer now?" You would probably conclude either that I was an idiot or that I had mistaken you for one. And yet, in 1,999 feet's frenzy over .com stocks, online traders acted exactly as if 2 nickels were more valuable than 1 dime. In fact, just the news that a stock would be splitting 2 for 1 could instantly drive its shares up 20% or more. Why? Because getting more shares makes people feel richer. Someone who bought 100 shares of Exodus in January watched them turn into 200 when the stock split in April. Then those 200 turned into 400 in August. Then the 400 became 800 in December. It was thrilling for these people to realize that they had gotten 700 more shares just for owning 100% in the first place. To them, that felt like found money, never mind that the price per share had been cut in half with each split. In December 1999, one elated Exodus shareholder who went by the handle GiveMeDollar exulted on an online message board. "I'm going to hold these shares because after it splits hundreds of times over the next years, I'll be close to becoming CEO." 5. What about Exodus the business? Graham wouldn't have touched it with a 10-foot pole and a hazmat suit. Exodus's revenues were exploding, growing from $52.7 million in 1998 to $242.1 million in 1999, but it lost $130.3 million on those revenues in 1999, nearly double its loss the year before. Exodus had $2.6 billion in total debt and was so starved for cash that it borrowed $971 million in the month of December alone. According to Exodus's annual report, that new borrowing would add more than $1 million to its interest payments in the coming year. The company started with $1 million in cash, and even after raising $1 billion in new financing, finished the year with a cash balance of $1 billion, meaning that its businesses had devoured more than $400 million in cash during 1999. How could such a company ever pay its debts? But of course, online traders were fixated on how far and fast the stock had risen, not on whether the company was healthy. "This stock," bragged a trader using the screen name of Launchpad, "will just continue climbing to infinity and beyond." 6. The absurdity of Launchpad's prediction, "what is beyond infinity," is a perfect reminder of one of Graham's classic warnings. Today's investor, Graham tells us, is so concerned with anticipating the future that he is already paying handsomely for it in advance. Thus, what he has projected with so much study and care may actually happen and still not bring him any profit. If it should fail to materialize to the degree expected, he may in fact be faced with a serious temporary and perhaps even permanent loss, where the ES ended up. How did these 4 stocks perform after 1999? Emerson Electric went on to gain 40.7% in 2000s. Although shares lost money in both, and they nevertheless ended less than below their final price of. EMC also rose in 2000s, gaining 21.7%. But then the shares lost 79.4% in 2001 and another 54.3% in 2002. That left them 88% below their level at year-end 1999. What about the forecast of $10 billion in revenues by 2001? EMC finished that year with revenues of just $7.1 billion and a net loss of $508 million. Meanwhile, as if the bear market did not even exist, Expeditors International shares went on to gain 22.9% in 2000s, 6.5% in 2001, and another 15.1% in 2002, finishing that year nearly 51% higher than their price at the end of 1999. Exodus's stock lost 55% in 2000s and 99.8% in 2001. On September 26, 2001, Exodus filed for Chapter 11 bankruptcy protection. Most of the company's assets were bought by Cable and Wireless, the British telecommunications giant. Instead of delivering its shareholders to the promised land, Exodus left them exiled in the wilderness. As of early 2003, the last trade in Exodus's stock was at 1 penny A, Share. CHAPTER14. Stock selection for the defensive investor. It is time to turn to some broader applications of the techniques of security analysis. Since we have already described in general terms the investment policies recommended for our two categories of investors, it would be logical for us now to indicate how security analysis comes into play in order to implement these policies. The defensive investor who follows our suggestions will purchase only stocks. High-grade bonds plus a diversified list of leading common. He is to make sure that the price at which he bought the latter is not unduly high as judged by applicable standards. In setting up this diversified list, he has a choice of two approaches, the DJIA type of portfolio and the quantitatively tested portfolio. In the first, he acquires a true cross-section sample of the leading issues, which will include both some favored growth companies whose shares sell at especially high multipliers, and also less popular and less expensive enterprises. This could be done, most simply perhaps, by buying the same amounts of all 30 of the issues in the Dow Jones Industrial Average, DJIA. 10 shares of each, at the 900 level for the average, would cost an aggregate of about $16,000. On the basis of the past record, he might expect approximately the same future results by buying shares of several representative investment funds. His second choice would be to apply a set of standard, S to each, purchase to make sure that he obtains a minimum of quality in the past performance and current financial position of the company, and also to a minimum of quantity in terms of earnings and assets per dollar of price. At the close of the previous chapter listed 7 such quality and quantity criteria suggested for the selection of specific common stocks. Let us describe them in order. 1. Adequate size of the enterprise. All our minimum figures must be arbitrary, and especially in the matter of size required. Our idea is to exclude small companies which may be subject to more than average vicissitudes, especially in the industrial field. There are often good possibilities in such enterprises, but we do not consider them suited to the needs of the defensive investor. Let us use round amounts, not less than $100 million of annual sales for an industrial company, and not less than $50 million of total assets for a public utility. 2. A sufficiently strong financial condition. For industrial companies, current assets should be at least twice current liabilities, a so-called 2-to-1 current ratio. Also, long-term debt should not exceed the net current assets, or working capital. For public utilities, the debt should not exceed twice the stock equity at book value. 3. Earning stability. Some earnings for the common stock in each of the past 10 years. 4. Dividend record. Uninterrupted payments for at least the past 20 years. 5%. Earnings growth. Minimum increase of at least 1/3 in per share earnings in the past 10 years using 3-year averages at the beginning and end. 6. Moderate price earnings ratio. INGS. Current price should not be more than 15 times average earn of the past 3 years. 7. Moderate ratio of price to assets. Current price should not be more than 11.2 times the book value last reported. However, a multiplier of earnings below 15 could justify a correspondingly higher multiplier of assets. As a rule of thumb, we suggest that the product of the multiplier times the ratio of price to book value should not exceed 22.5. This figure corresponds to 15 times earnings and 11.2 times book value. It would admit an issue selling at only 9 times earnings and 2.5 times asset value, etc. General comments. These requirements are set up especially for the needs and the temperament of defensive investors. They will eliminate the great majority of common stocks as candidates for the portfolio, and in 2 opposite ways. On the one hand, they will exclude companies that are 1, too small, 2, in relatively weak financial condition, 3, with a deficit stigma in their tenure record, and 4, not having a long history of continuous dividends. Of these tests, the most severe under recent financial conditions are those of financial strength. Financial conditions are those of financial strength. A considerable number of our large and formerly strongly entrenched enterprises have weakened their current ratio or overexpanded their debt, or both, in recent years. Our last two criteria are exclusive in the opposite direction by demanding more earnings and more assets per dollar of price than the popular issues will supply. This is by no means the standard viewpoint of financial analysts. In fact, most will insist that even conservative investors should be prepared to pay generous prices for stocks of the choice companies. We have expounded our contrary view above. It rests largely on the absence of an adequate factor off safety when too large a portion of the price must depend on ever-increasing earnings in the future. The reader will have to decide this important question for himself after weighing the arguments on both sides. We have nonetheless opted for the inclusion of a modest requirement of growth over the past decade. Without it, the typical company would show retrogression, at least in terms of profit per dollar of invested capital. There is no reason for the defensive investor to include such companies, though if the price is low enough, they could qualify as bargain opportunities. The suggested maximum figure of 15 times earnings might well result in a typical portfolio with an average multiplier of, say, 12 to 13 times. Note that in February 1972, American Intel sold at 11 times its 3-year and current earnings, and Standard Oil of California at less than 10 times latest earnings. Our basic recommendation is that the stock portfolio, when acquired, should have an overall earnings price ratio, the reverse of the PE ratio, at least as high as the current high-grade bond rate. This would mean a PE ratio no higher than 13.3 against and double a bond yield of 7.5%. Application of our criteria to the DJIA at the end of 1970. All of our suggested criteria were satisfied by the DJIA issues at the end of 1970, but 2 of them just barely. Here's a survey based on the closing price of 1970 and the relevant figures. The basic data for each company are shown in tables 14-1 and 14-2. 1. Size is more than ample for each company. 2. Financial condition is adequate in the aggregate, but not for every company. 2. 3. Some dividend has been paid by every company since, at least, 1940. 5 of the dividend records go back to the last century. 4. The aggregate earnings have been quite stable in the past decade. None of the companies reported a deficit during the prosperous period 1961 to 69, but Chrysler showed a small deficit in 1970. 5. The total growth comparing 3-year averages a decade apart was 77%, or about 6% per year, but 5 of the firms did not grow by 1/3. Limit 6. The ratio of year-end price to 3-year average earnings was $839 to $55.50, or 15-1, right at our suggested upper 7. The ratio of price to net asset value was 839 to 562, also just within our suggested limit of element 2 to 1. If, however, we wish to apply the same 7 criteria to each individual company, we would find that only 5 of them would meet all our requirements. These would be American Can, American Intel, Anaconda, Swift, and Woolworth. The totals for these 5 appear in table 14-3. Naturally, they make a much better statistical showing than the DJIA as a whole, except in the past. Growth rate. 3. Our application of specific criteria to this select group of industrial stocks indicates that the number meeting every one of our tests will be a relatively small percentage of all listed industrial issues. We hazard the guess that about 100 issues of this sort could have been found in the Standard & Poor's stock guide at the end of 1970. Just about enough to provide the investor with a satisfactory range of personal choice. The public utility solution. If we turn now to the field of public utility stocks, we find a much more comfortable and inviting situation for the investor. Here, the vast majority of issues appear to be cut out by their performance record and their price ratios in accordance with the defensive investor's needs as we judge them. We exclude 1 criterion from our test of public utility stocks, namely the ratio of current assets to current liabilities. The working capital factor takes care of itself in this industry as part of the continuous financing of its growth by sales of bonds and shares. We do require an adequate proportion of stock capital to debt. 4. In Table 14-4, we present a raw sum of the 15 issues in the Dow Jones Public Utility Average. For comparison, Table 14-5 gives a similar picture of a random selection of 15 other utilities taken from the New York Stock Exchange list. As 1972 began, the defensive investor could have had quite a wide choice of utility common stocks, each of which would have met our requirements for both performance and price. These companies offered him everything he had a right to demand from simply chosen common stock investments. In comparison with prominent industrial companies as represented by the DJIA, they offered almost as good a record of past growth, plus smaller fluctuations in the annual figures, both at a lower price in relation to earnings and assets. The dividend return was significantly higher. The position of the utilities as regulated monopolies is assuredly more of an advantage than a disadvantage for the conservative investor. Under law, they are entitled to charge rates sufficiently remunerative to attract the capital they need for their continuous expansion, and this implies adequate offsets to inflated costs. While the process of regulation has often been cumbersome and perhaps dilatory, it has not prevented the utilities from earning a fair return on their rising invested capital over many decades. For the defensive investor, the central appeal of the public utility stocks at this time should be their availability at a moderate price in relation to book value. This means that he can ignore stock market considerations if he wishes and consider himself primarily as a part owner of well-established and well-earning businesses. The market quotations are always there for him to take advantage of when times are propitious, either for purchases at unusually attractive low levels or for sales when their prices seem definitely too high. The market record of the public utility indexes condensed in Table 14-6, along with those of other groups, indicates that there have been ample possibilities of profit in these investments in the past. While the rise has not been as great as in the industrial index, the individual utilities have shown more price stability in most periods than have other groups. It is striking to observe in this table that the relative price-earnings ratios of the industrials and the utilities have changed places during the past 2 decades. These reversals will have more meaning for the active than for the passive investor. But they suggest that even defensive portfolios should be changed from time to time, especially the securities purchased have an apparently excessive advance and can be replaced by issues much more reasonably priced. Alas, there will be capital gains taxes to pay, which for the typical investor seems to be about the same as the devil to pay. Our old ally, experience, tells us here that it is better to sell and pay the tax than not sell, and repent. Investing in stocks of financial enterprises, a considerable variety of concerns may be ranged under the rubric of financial companies. These would include banks, insurance companies, savings and loan associations, credit and small loan companies, mortgage companies, and investment companies, e.g., mutual funds. It is characteristic of all these enterprises that they have a relatively small part of their assets in the form of material things such as fixed assets and merchandise inventories, but on the other hand, most categories have short-term obligations well in excess of their stock capital. The question of financial soundness is therefore more relevant here than in the case of the typical manufacturing or commercial enterprise. This in turn has given rise to various forms of regulation and supervision with the design and general result of assuring against unsound financial practices. Broadly speaking, the shares of financial concerns have produced investment results similar to those of other types of common shares. Table 14-7 shows price changes between 1948 and 1970 in 6 groups represented in the Standard & Poor's stock price indexes. The average for 1941 to 1943 is taken as 10, the base level. The year-end 1970 figures range between 44.3 for the 9 New York banks and 218 for the 11 life insurance stocks. During the subintervals, there was considerable variation in the respective price movements. For example, the New York City bank stocks did quite well between 1958 and 1968. Conversely, the spectacular life insurance group actually lost ground between 1963 and 1968. These cross movements are found in many, perhaps most, of the numerous industry groups in the Standard & Poor's indexes. We have no very helpful remarks to offer in this broad area of investment, other than to counsel that the same arithmetical standards for price in relation to earnings and book value be applied to the choice of companies in these groups as we have suggested for industrial and public utility investments. Railroad issues. The railroad story is a far different one from that of the utilities. The carriers have suffered severely from a combination of severe competition and strict regulation. Their labor cost problem has, of course, been difficult as well, but that has not been confined to rail. Roads, automobiles, buses, and airlines have drawn off most of their passenger business and left the rest highly unprofitable. The trucks have taken a good deal of their freight traffic. More than half of the railroad mileage of the country has been in bankruptcy or trusteeship at various times during the past 50 years, but this half-century has not been all downhill for the carriers. There have been prosperous periods for the industry, especially the war years. Some of the lines have managed to maintain their earning power and their dividends despite the general difficulties. The Standard & Poor's Index advanced sevenfold from the low of 1942 to the high of 1968, not much below the percentage gain in the Public Utility Index. The bankruptcy of the Penn Central Transportation Company, our most important railroad, in 1970 shocked the financial world. Only a year and 2 years previously, the stock sold at close to the highest price level in its long history, and it had paid continuous dividends for more than 120 years. On P423 below, we present a brief analysis of this railroad to illustrate how a competent student could have detected the developing weaknesses in the company's picture and counseled against ownership of its securities. The market level of railroad shares as a whole was seriously affected by this financial disaster. It is usually unsound to make blanket recommendations of whole classes of securities, and there are equal objections to broad condemnations. The record of railroad share prices in Table 14.6 shows that the group as a whole has often offered chances for a large profit, but in our view, the great advances were in them. Selves largely unwarranted. Let us confine our suggestion to this. There is no compelling reason for the investor to own railroad shares. Before he buys any, he should make sure that he's getting so much value for his money that it would be unreasonable to look for something else instead. Selectivity for the defensive investor. Every investor would like his list to be better or more promising than the average. Hence, the reader will ask whether, if he gets himself a competent advisor or security analyst, he should not be able to count on being supplied with an investment package of really superior merits. After all, he may say, the rules you have outlined are pretty simple and easygoing. A highly trained analyst ought to be able to use all his skill and techniques to improve substantially on something as obvious as the Dow Jones list. If not, what good are all his statistics, calculations, and pontifical judgments? Suppose, as a practical test, we had asked 100 security analysts to choose the best 5 stocks in the Dow Jones average to be bought at the end of 1970. Few would have come up with identical choices, and many of the lists would have differed completely from each other. This is not so surprising as it may at first appear. The underlying reason is that the current price of each prominent stock pretty well reflects the salient factors in its financial record plus the general opinion as to its future prospects. Hence, the view of any analyst that one stock is a better buy than the rest must arise to a great extent from his personal partialities and expectations, or from the placing office emphasis on one set of factors rather than on another. In his work of evaluation, if all analysts were agreed that one particular stock was better than all the rest, that issue would quickly advance to a price which would offset all of its previous advantages. Our statement that the current price reflects both known facts and future expectations was intended to emphasize the double basis for market valuations. Corresponding with these two kinds of value elements are two basically different approaches to security analysis. To be sure, every competent analyst looks forward to the future rather than backward to the past, and he realizes that his work will prove good or bad depending on what will happen and not on what has happened. Nevertheless, the future itself can be approached in two different ways, which may be called the way of prediction or projection and the way of protection. Those who emphasize prediction will endeavor to anticipate fairly accurately just what the company will accomplish in future years in particular, whether earnings will show pronounced and persistent growth. These conclusions may be based on a very careful study of such factors as supply and demand in the industry or volume, price, and costs, or else they may be derived from a rather naive projection of the line of past growth into the future. If these authorities are convinced that the fairly long-term prospects are unusually favorable, they will almost always recommend the stock for purchase without paying too much regard to the level at which it is selling such. For example, was the general attitude with respect to the air transport stocks, an attitude that persisted for many years despite the distressingly bad results often shown after 1946. In the introduction, we have commented on the disparity between the strong price action and the relatively disappointing earnings record of this industry. By contrast, those who emphasize protection are always slyly concerned with the price of the issue at the time of study. Their main effort is to assure themselves of a substantial margin of indicated present value above the market price, which margin could absorb unfavorable developments in the future. Generally speaking, therefore, it is not so necessary for them to be enthusiasts. Take over the company's long-run prospects as it is to be reasonably confident that the enterprise will get along. The first, or predictive, approach could also be called the qualitative approach, since it emphasizes prospects, management, and other non-measurable, albeit highly important, factors that go under the heading of quality. The second, or protective, approach may be called the quantitative or statistical approach, since it emphasizes the measurable relationships between selling price and earnings, assets, dividends, and so forth. Incidentally, the quantitative method is really an extension into the field of common stocks of the viewpoint that security analysis has found to be sound in the selection of bonds and preferred stocks for investment. In our own attitude and professional work, we were always committed to the quantitative approach. From the first, we wanted to make sure that we were getting ample value for our money in concrete, demonstrable terms. We were not willing to accept the prospects and promises of the future as compensation for a lack of sufficient value in hand. This has by no means been the standard viewpoint among investment authorities. In fact, the majority would probably subscribe to the view that prospects, quality of management, other intangibles, and the human factor far outweigh the indications supplied by any study of the past record, the balance sheet, and all the other cold figures. Thus, this matter of choosing the best stocks is at bottom a highly controversial one. Our advice to the defensive investor is that he let it alone. Let him emphasize diversification more than individual selection. Incidentally, the universally accepted idea of diversification is, in part at least, the negation of the ambitious pretensions of selectivity. If one could select the best stocks unerringly, one would only lose by diversifying. Yet within the limits of the four most general rules of common stock selection suggested for the defensive investor on pp 114-115, there is room for a rather considerable freedom of preference. At the worst, the indulgence of such preferences should do no harm. Beyond that, it may add something worthwhile to the results. With the increasing impact of technological developments on long-term corporate results, the investor cannot leave them out of his calculations. Here, as elsewhere, he must seek a mean between neglect and overemphasis.